Are you familiar with Blackstone and Blackrock? Well, today we'll be looking at these two companies and see how money works for them that some people think that they are evil companies. But before that, welcome to Detective Finance, where we'll be looking at and sharing some insights and information about the world of finance. Subscribe to our channel so you'll never miss any of our videos. And without further ado, let's get started. Finance firms BlackRock and Blackstone jointly control assets valued at trillions of dollars. Some of your funds may be under the control of these businesses without your knowledge. The housing affordability crisis has been attributed to Blackstone and BlackRock, who both made investments in the disastrous FTX. How do these businesses function? Are these businesses the worst? Nope. I'm sorry to ruin your good time, but these are just regular investment companies without ominous music and carefully crafted headlines. Obtaining a thorough understanding of how these businesses function, in my opinion, is the best way to realize this, so that you can make a choice and learn how money works, how these companies make money, and to whom they are accountable. There are two asset management firms with the word Black in their names, Blackstone and BlackRock, both of which are based in New York. Blackstone was established in 1985 by Stephen A. Schwarzman and his former Lehman Brothers boss, Peter Peterson. His name is that, hence the name of the company. Blackstone is a combination of the Germanic word for black, Schwarz, and stone, Petra, or Peter in Greek. Wealthy investors who wanted to make impossibly high investments gave Blackstone money. It started financing acquisitions and mergers. Because Schwarzman oversaw the M&A department at Lehman Brothers, businesses trusted his ability to close deals. M&A deals and business acquisitions were mediated by Blackstone, similar to a realtor, but instead of selling homes, they sell businesses. Blackstone needed to raise money because it is profitable to underwrite M&A transactions. If something goes wrong, the underwriting company might be held responsible for damages and would have to demonstrate sufficient funds. Early M&A services provided by Blackstone were profitable. The company only received a few $1,000,000 in commission from each profitable deal. But Schwarzman had loftier objectives. He sought to raise money for a private equity fund that makes investments in unlisted businesses. Blackstone wanted to invest in private equity because doing so would allow them to invest in assets that were unavailable to the general public and earn substantial returns and fees. To get around this at first, Blackstone used a merchant banking model, a term from Wall Street from entering into deals with an investor partner. They would contribute their business and M&A experience, and the investor partner would contribute funding. Although this plan only worked for a year, it proved to their wealthy investors that they were capable of closing their private equity deals and raising their capital. By 1988, Blackstone had grown to include a variety of investment vehicles, including a brand new business that was nearly the polar opposite of what they were already doing. BlackRock was established as a 50-50 partnership by Blackstone and a few Wall Street veterans, including Larry Fink, a senior executive at Blackstone who later rose to the position of CEO. Schwarzman and Fink made this choice on purpose. They went ahead with it nonetheless because they liked the concept of a family of investment firms. BlackRock was established to make investing in public companies simple for average investors, whereas Blackstone catered to wealthy investors seeking exclusive deals. BlackRock specializes in index funds. For a small fee, BlackRock combines these assets and sells shares. These shares are offered both directly to investors and on a variety of international stock exchanges by BlackRock. Investors who want market exposure but lack the resources to purchase foreign assets will find this convenient. With IVV, a weighted S&P 500 index, managing $295 billion alone, BlackRock is one of the big three index fund managers, along with State Street and Vanguard. Ordinary investors can get a diversified portfolio without having to buy a weighted portfolio of shares, which would cost at least $2 million to have weighted exposure to the S&P 500. Blackstone, the first private equity firm, manages $800 billion, while BlackRock manages over $10 trillion. The company that founded BlackRock might appear larger and more successful as a result, but BlackRock only earns a small commission on the assets it manages. Even though Blackstone manages 10% fewer assets, it still makes the same amount of revenue and net profit. Schwarzman's business sold its BlackRock shares in the middle of the 1990s. Despite the name, the only things the companies have in common are their names and histories. Are these businesses bad? No, to their shareholders. All businesses owe a fiduciary duty to maximize profits while abiding by the law. These businesses can act in ways that people dislike to increase shareholder value. Additionally, the direct purchasers of these companies' goods are owed fiduciary obligations. Some shareholders of BlackRock and Blackstone don't have any financial assets. Without owning any shares, millions of people invest in the financial products of these companies. When in doubt, visualize a bank inside a bank account. A bank account is not necessary to own bank shares. Another option is a bank account without any stock. You should check to make sure the bank is safeguarding your funds though. One of these companies can perform well while the other performs poorly, or the other way around. However, the management of both businesses wants their investors to be successful. Sales of financial products please shareholders. To be successful, financial products must sell. The biggest problem for BlackRock is its asset size. The firm controls the majority of the largest corporations in the world and oversees assets worth $10 trillion. Management at BlackRock has sway over shareholders' decisions regarding corporate strategy, but only partially. Many significantly businesses are owned by BlackRock, but not all. They buy them for the investors in their index funds. The business votes on shareholder proposals, but they make an effort to be open about it. Investors in index funds can also weigh in on BlackRock's decision. In a CEO election for a company in which BlackRock owns 20%, BlackRock will vote for A if 55% of index fund investors choose A over B. Investors in BlackRock funds generally don't vote. I find it amusing that Vanguard manages nearly identical assets to BlackRock and runs in a nearly identical fashion. Yet, BlackRock receives so much negative press for being an evil empire secretly in charge of corporate America. I can only assume that less experienced writers of financial content think BlackRock sounds evil. Perhaps Blackstone should take some heat. Residential real estate has seen significant private equity investment. To build and scale an investment property portfolio quickly, Blackstone used shared management costs, up-to-date market information, and lower interest rates than individual home buyers and investors. Thanks to these asset class, wealthy clients could invest millions or billions of dollars in residential real estate without having to find, finance, and manage tens of thousands of properties. Blackstone can provide market access to wealthy investors for less money than a property manager. Blackstone has made real estate investments totaling more than $280 billion. According to Blackstone's investor reports, the average family renting a Blackstone home makes nearly twice as much as the national average. Initially, the company made investments in shopping malls, businesses, warehouses, and hospitals. Blackstone made money for its investors by purchasing real estate, but it might have harmed regular people who want to buy a home. Blackstone's regional managing directors rarely haggle over home prices because the company has almost infinite capital. Blackstone often enters home sales and makes offers that are much higher than the asking price. This helps them close quickly and move on to their next purchase. If Blackstone already owns enough properties in a certain area, paying too much for one of them could raise the value of all the others, since appraisers and real estate agents base future prices on the most recent sales. If BlackRock purchases a comparable home for $600,000, the $500,000 homes in the neighborhood will increase to $600,000 because that is what the market will bear. They overpaid by $100,000, but their investors received a $20 million capital gain. BlackRock can show investors impressive profits even though they would have a hard time getting those profits if they had to sell their real estate. For private equity investors, the mark-to-market fallacy is a warning sign. It is simpler to explain the price premium for single-family homes by pointing out how it differed from their prior investments. It's one thing to embellish the truth for investors, but this process has driven up housing costs, making it more difficult for people to find a place to live. Only 2% of single-family homes in America are owned by Blackstone. In total, 0.6% of single-family homes are owned by institutional investors. Even though that's a lot of homes, it should disprove the claim that Blackstone is buying up all of America's real estate and forcing regular people to leave the market. These two businesses need to increase investment returns. The names of these formidable and widely misunderstood institutions are largely to blame for the controversy. Their company websites exaggerate their role as forces that can save the world. They are also not nefarious empires vying for global dominance. So what do you guys think about Blackstone and BlackRock's business strategies? For you, are they really evil companies? Let us know what you think in the comments section below. And that's it for today. Thanks for watching. Please like this video and subscribe to our channel for more content like this. See you at the next one.